much. Like Shepherd and a lot of you, Mark, we've spoken once or twice about when we wanted some insight into Zim pensions industry. So it's good to be here. Thank you all for making the time. So I think Shepherd covered most of my background pretty well. What he didn't mention is that I'm born and raised here in Harare. So I spent most of my formative years in these streets, so to speak. And I left 12 years ago to go to the University of Southampton. So after my A-level, I went off to the UK, where I did my BSc in Actuarial Studies, or Maths and Actuarial Studies. And then in my second year, a company called Jardine Lloyd Thompson, an actuarial consultancy, came to the university, and they wanted 2 people from my year to do an internship. I got one of those. And then they also gave us £5,000 each. Now I didn't tell my parents about the £5,000, so maybe you can edit that out of the video. And then I then eventually got the graduate job, and I thought, let me just stay and then get some experience. And so from that point on, I did start to volunteer for the profession. And so it started off with being an editor of the magazine, but a lower level editor, which then helped me to actually get the job 4 years later when I then applied for it, because I knew the people, I knew the structure. And then arguably that's what led to me actually going onto council and helping with the strategic direction and vision of our profession. So in terms of volunteering, I would not be standing here if I wasn't a volunteer. So it's through that I'm actually here standing in front of you. So although you don't get paid for it, the benefits do come down the line. So it's something that I'm very passionate about, and something I think all of us, in fact, should do. We all have a contribution to make. So I then joined Deloitte after Jardine Lloyd Thompson for 4 years, where I was in the pensions actuarial department. And then after that, I joined Towers Watson, where I am now, 5 years ago. What's the date? 13th of November. I joined on the 10th. What's that, Tuesday? So 5 years on Tuesday. I'm probably due some sort of service award or something. I should check when I get back. So that's what I've been up to. Anyway, so let's go into the presentation. What are we going to do today? First of all, I'll start by talking about some of the interesting things we're doing in the UK around savings, investment, and insurance. And I know Shep had made a very good point as we were discussing what would be good to talk about, in that the developed markets and the developing markets are quite distinct. I think it's quite dangerous to look at a model that works in one and assume that it necessarily works in the other. So I think we should just have that in the back of our minds when we talk about this. But hopefully there is some overlap, right? So hopefully some of the things I say, you might be able to think, well, actually in our context, could that work? So if that sparks that light bulb moment, then I think my job is done. But just do have that in the back of your mind, that actually this is a completely different context. And so that's kind of the way I'll talk through the presentation, and that even in terms of the future for actuaries, you'll see with some of the stats that the future is quite different in the developed and developing markets. And so you can almost see them as two separate segments of actuarial work and the actuarial profession. So I'll talk about where we've come from in the UK. I'll talk about the trends we're seeing now, and then talk about what I think the winning model in the future is. Some of the stuff which I'm involved with on a personal level. And I want to talk about our profession, right? The profession we know and love so much. Talking about, but this is more from a global context. So what are the trends, and what is the future for us as actuaries? Actuaries, we love to put our caveats. So I'll just caveat by saying all of this stuff I'm going to talk about is very much my personal view. I'm not representing my employer, nor am I representing the Institute of Active Actuaries, nor am I talking on behalf of the Actuary magazine. Okay, right? So that, you can keep that on the video. Okay, so let's share some learnings. Please do interact. I want to hear your comments. I want to hear your questions. Please do just put your hand up. But all I'd ask is that you let me know your name before you speak, because I want to get to know you guys too. We'll leave some time for Q&A at the end, and then I'll stay around after that. So in case you guys want to have a one-to-one conversation with me, then feel free to wait until then. I'll be around. Okay. I know Mark, I was told that Mark asks the most challenging questions. So I hope you live up to your reputation, Mark, and asking some questions. Okay. So if we move into the slides now. In terms of the history of pensions in the UK, back in the day, you used to have very high interest rates in the UK. So what that did is it reduced your liabilities and hence your deficits. You had quite strong equity markets back then. So you had situations where a lot of schemes had big surpluses. Right? So you had companies taking contribution holidays, such that they can eat up into that surplus. And then things changed, probably in the last 15, 20 years, where we started to see a lot of improvements in longevity. So not just in terms of base longevity, but also the expected future improvements, which, as you know, you have to allow for when you value liabilities. So we saw the liabilities going up because people are living longer. And at the same time, more recently, due to the global financial crisis, we then saw the government bond yields starting to come down. And the way we value our funds, it is based on a government bond yield. So as the yield moves, so do your liabilities. There is a bit of a margin above the yield, but generally, as the yield moves, so does the liabilities. And what caused the reduction in yields? I think partly was the quantitative easing. So as you know, the economy needed a bit of a kickstart. And so the Bank of England started quantitative easing, essentially putting money into the economy. And then you also had the turmoil in Europe, which resulted in a lot of people seeing UK government bonds as a safe haven. Now you know with UK government, with bonds, the more money you put in, the higher the demand, the lower the yield then becomes. And so that also served to reduce those yields. So we used to have surpluses that turned around, and it's very much, it's hard to find any schemes which are in surplus. Most are in deficit. And we'll talk through some of the things we're doing to help schemes that are in that situation. And then you also have the regulation of the accounting standards, which required a more market value-based valuation. So for your assets, rather than a discounted cash flow, you look at the actual market value. And to value liabilities, you have to look at the actual the value of your yields on the date of measurement. And so what that does, given things change, in the short term, it made your balance sheet quite volatile. And so that's kind of where we are now, where you're seeing underfunded schemes. You're seeing whenever you think yields are low, they go lower still. And so that's what a lot of companies have been grappling with. I'm not sure to what extent that resonates with what's going on in Zimbabwe, whether, but
if you were to give just a breakdown of how many pension funds or companies are facing deficit, what fraction of pension funds are in that?
I'll say the vast majority of them. At Towers Watson, we have, the company I work for now, we consult to about 80% of the FTSE 100 companies. So those are the 100 biggest companies by market cap in the UK. And pretty much all of them are in deficit, and they represent the largest share of the market. In terms of private sector pension fund liability assets, you've probably got about £1 trillion of assets in private sector sort of occupational pension schemes, and the vast majority of that are in deficit. So I'll talk through some of the things that are then happening as a result of that. In that companies are facing the pinch, for cash. Companies don't have cash yet. Trustees of pension schemes are saying, well, we want more money because our deficit has grown bigger. And so you've then got this conflict in objectives and interests. And I'll talk through how that's playing out now. And so some of it may well be applicable here, given the liquidity constraints that the economy is facing. Okay. So I just thought to start off with this, just to set the context for what I'm now going to talk about in terms of what we're seeing in current trends. So if you look at the box at the top, what I'm trying to do there is just try to show you in one picture the general consulting model. Okay, so in the middle you've got all the tasks that you do. So first you agree the time cost, or agree the task and the cost of it, so this is your scope of work and your fee estimate. Then you go on to do the work and then you deliver the results. So in terms of the time cost, agreeing the task and the scope doesn't actually take that much time or cost, but it's actually doing the work that takes you a lot of the time, all the number crunching, all the preparing the reports, the graphs, etc. Then when you deliver the results, that might be a 1-2 hour, maybe half a day meeting. So again, relatively that's not as much time. But actually, if you then look at it from the perspective of the client or the employer, if you're in an in-house role, how do they perceive, what's the value that they perceive from each stage of the work? Well, actually, when you're agreeing the task, they're relatively very little. When you're doing the work, they don't see you, staying late at work. They don't see you getting in early. They don't see you, working at the weekend. So they don't perceive that as high value. And then when you then deliver the results, you tell them, okay, this is the results, and this is what we think you should do to help you with your issues. Then they see a lot of value in that. And so what we're seeing is a lot of, to almost move the value to where it's perceived the most, we're having to start to commoditize a lot of the work we do. So that bit about doing the work, we're trying to push down the cost of that. So you see a lot of companies starting to offshore their actual number crunching, so they'll send it to India or they'll send it off to Ireland because it's a much lower cost base for the numbers to be done. And as long as you've got the method and they know exactly what steps to take, then actually you don't really need an actuarial student, for example, to do that work. You can have someone who's good at spreadsheets, for example, or someone who's good with the valuation software because it's all been set up. And so actually one of the things we're seeing is where you're a student, you're doing less of the mechanical work and you're not doing a lot more of the numbers have come back, do they look right, or do you need to send them back offshore and say, hang on guys, based on the data, your liabilities don't quite match. So it's then sort of your higher order skills, your ability to stand back and saying, does this, the smell test, I like to call it, does this look and feel right? And then it's also trying to demonstrate value, right? Because they want to pay you, say, 50,000 for a project. So you want to be able to say, okay, you've paid us 50 grand for a project, and we've saved you 500,000 in annual contributions because of the strategy we've come up for you. So there's a lot of trying to show the value and demonstrate that actually we're doing a lot of work, and it's not just the delivery of the results. And so that means we need to innovate and think about different ways of doing things. And I'll come on to some of the things we're doing in that space. Okay. Is it okay so far? Any comments? How is that different here in Zim? Does some of it resonate?
Yeah, I wanted to ask about the part where you say commoditize.
Mm-hmm.
To what extent are UK companies sort of offshoring?
To a very large extent. So at my company, Charles Watson, the company I work for, they do all the valuations outside of the UK, in Lisbon, in the valuation centre. And they're now thinking of actually doing more. So annually, you have to do actual evaluations every 3 years, and then annually you just do a rough update without using its own evaluation. So they think of even getting that offshore. And I know some actuarial consultants in the UK actually have stopped recruiting graduates. Because that old model where you get lots of graduates, they do all the work, and then the partner then signs it off is changing. And so they've actually stopped recruiting graduates. And so they're recruiting things like PhD students. Right? Because PhD students, they know how to think in a different way, they know how to write reports. So that's kind of what's happening. And so we at the Institute, we realize this, we recognize this, and so we need to make changes if we're going to carry on and to continue to thrive as a profession. But it is very, very prevalent, commoditization. So that whole model where it's, I spend 5 hours and I charge £200 each hour, here's your bill for £1,000, it's not quite the same. So clients are coming and saying, well, actually, how do I know that it actually takes 5 hours? Can we not just agree on, £600, for example, and then that's done. And then if you spend longer, then that's your loss. But I've got certainty. So it's becoming more of a product or solutions rather than the old consulting model of spend as long as you want, send them a bill, and pay the invoice before you hear. So it's the changes. So
do you think there is value in Zimbabwe almost trying to be a hub as well?
I think so. I think Zimbabwe has got some, my personal view, I think Zimbabwe has got its advantages, right? In that, particularly from a UK perspective, in that time zone wise, at most 2 hours, within. So it's not as if, it's not like India, for example, where, you have to make sure you send them, and, So you've got a lot of overlap during the working day to be able to interact with your valuation center and say, well, hang on, this data, the numbers, and have that conversation. And I'll say the other thing is Zimbabweans have got a very good command of English. than other countries, particularly African countries that I see. And I think it's a bit fluent and a bit more understandable, I must say. And that's not only because I'm Zimbabwean and I speak Chinese, but I think it's not as strong an accent. And so I think Zimbabwe has advantages. Whether or not it could work, I don't know. What do you think?
Maybe we tell about it.
Yeah.
Because I think it could work because we've got an increasing pool of actuarial students. If we've got quite a big pool of good programmers, we can actually program the software whichever one we want to use. So once we've agreed on the model, we can bring up on the assumptions. It could actually be a good revenue generator from the market.
What about the power issues, though?
We're using it right now.
I mean, I agree with John. There's a massive pool of talent in Zimbabwe, and most people actually struggling to find their actual work. The downside of that question is the view of UK-based clients. How comfortable are they knowing that their data and their information is being sent to Zimbabwe? Unfortunately, the name Zimbabwe is still a bit toxic in certain areas. So, I'm not sure.
And that's a good point. I think it is very important, which I think is what you're doing now, is thinking from the user's perspective, how do they see this? And you're right, data security is a huge issue. Before we send even a spreadsheet with 1 + 1 = 2, you have to put a password, you have to encrypt it, you have to send it in an email, and then you have to tell them the password using a separate mode of communication. So there's all this red tape around data. And then the other issue you'll find is there's certain regulations that then come into play once you start sending data outside of the EU. Which Zimbabwe is. There's extra steps that you have to take. So I think that the data could be an obstacle, but I'd like to think it's not anything you can that you can't overcome. If it's just a case of saying to the client, look, this is what we're doing, because we had to communicate to all our clients when we're shipping over offshore, talk them through that, look, this is what we're doing, this is how we're sending the data, your data's safe, don't worry about that. But I think there's things you can do to ensure that security and the integrity of the data is upheld.
Are you aware of anyone that's using external people outside the EU?
I know South Africa was quite keen on being seen as an offshore center. My wife was telling me that she was on the phone with HSBC, one of the big 5 banks in the UK, and actually the customer service is rooted into South Africa, so South African accent. So maybe that's kind of that's an indication of the direction of travel. But from my personal view, I don't see there being any insurmountable obstacles. I must say, as I say, Zimbabwe's got quite a few things going for it compared to other territories.
Yeah, I think I have an example. I think Deloitte does that. But it's Deloitte to Deloitte.
Okay.
The team of actuarial professionals sitting in Joburg UK law. So I'm not sure about the data, how we deal with them, but in essence, I think it's something that
At the end of the day, right, you've probably got, I don't know how you store your data here, but in the UK, there's a lot of companies who then use cloud-based, so rather than be on a network, it's actually on the cloud, which all you need is an internet connection, right, and the right password to be able to access it. So I'm not sure whether that makes a difference in that, it's on the cloud, and if someone has the correct credentials to access it, then they can. So in a way, you're not actually sending data. It's just there. So there must be a way. There must be a way. Okay. Mark, I'm still waiting for the difficult questions.
I haven't come up with anything.
And so the core work, which I'm sure a lot of us do, is actuarial evaluations. So as I mentioned, that's being commoditized. The fee, there's a lot of fee pressure, so we're having to almost do that at less than cost. So we're having to incur a loss on doing that work. Welcome. So, but actually, the way we see valuations now is actually, we'll get them in, we'll do it at a loss, but actually what we'll look for is then the consulting opportunity on top of the bog standard valuation. So that's where a lot of the focus is then shifting on. That once you've done your valuation, what more can you, how more can you add value to the client beyond just, here's the results of the valuation, okay? And so I mentioned the number crunching offshore. And one of the things we do is, on assumptions, is postcode mortality studies. So postcode is similar to the zip code in the US. So if you're a big enough scheme and you have enough mortality experience and the data, then you can actually do some analysis and actually chart what your actual mortality it represents that group, right? So rather than using a standard table, you can actually use a more granular type approach to understanding what the mortality of your scheme, specific to your scheme, and where they live is. So that's one thing that we do, and that can save on the liability. If everybody lives in the north of England, which is a bit colder and a bit rougher, and you've got more chance of dying, then actually you can use that data and say, look, the trustees, look, our guys are living, are not living as long as the standard table is saying. So we shouldn't be valuing them with the life expectancy of 25. It's more like 23, and that saves you the bit on your liability. And then also, once you then do the numbers and you give them the assets, liability, what the deficit is, it's then the question then becomes, okay, fine, you've shown me that I've got a big gap of $200 million pounds. How do I fund it? Because let's face it, putting money into a pension scheme doesn't give you any return, or at least the company. In that, companies would rather invest in a new factory, for example, which they can then expand and be profitable, and they generate money that way. Whereas if you put money into a pension fund, you actually don't get any return back. And so a lot of companies are cash constrained. They'd rather put money elsewhere, and so they're thinking, well, what can I do? And the other thing is, if you remember, the objective of a pension is, or one of the objectives is as an attraction and retention tool for staff. It's an employee benefit, right? Just like salary, if high salary, you like to go there. But actually, with defined benefit, because the employee can't see the value of the pension, it's very difficult for them to appreciate how much it is. It's not like a DC, where DC might be 10% of your salary every year. And so you say, okay, if you're earning 50K, okay, fine, that's 5,000. You can put a value to that. But DB, you can't quite put a value to the amount of money that the company is funding it. And so companies are looking for different ways to fund it, and do it in a way that can be more appreciated by their employees. And so one of the things that they're doing is looking at non-cash funding strategies. So you've got a deficit, you don't have cash, what can we do? Well, actually, a lot of these companies will have, say, a factory or a property, which you can put together what they call a special purpose vehicle. And then you can pledge that asset into the special purpose vehicle, and then that essentially becomes an asset of the scheme, or at least a notional asset of the scheme. And it plugs the gap. And then you've got various payments going on between the company and the scheme through this purpose vehicle, without any cash actually changing hands. Another way to do it is you can get your parent company to maybe write a letter of guarantee, saying, okay, our subsidiary has this big deficit, but we will underwrite the scheme should anything go wrong. We're bigger, we've got more financial clout, we'll look after our small brother, for example. So there's various ways you can start to do this, and also negotiating for a longer recovery plan. So where the trustees might be saying, I want you to pay this thing off in 5 years, you could go in and negotiate and say, look, if we fund this thing in 5 years and we're making this amount of contributions, we're not going to have a business. Would you rather that we take longer to fund it, say 10 years, and employees still have a job, or 5 years and then the company shuts down because we've got no more cash and nobody has a job? So it's also helping the companies to have these negotiations with their trustees.
Yeah. My name is Mabas.
Hello, Mabas.
Yeah, I wanted to understand the impact of longevity risk and maybe the rate at which most of these pension funds are moving from DB to DC.
Mm-hmm.
To what extent?
If I'm honest with you, Mabasa, and I'll touch on DC, that's where I'm going with this. Longevity risk is not really the priority. It's actually investment risk. And I'll come on to that. And the reason is, if you look at value at risk, I don't know if you guys use value at risk. So looking at your 1 in 20 chance of your liabilities or your assets losing money, you'll actually see that the impact of a 1 in 20 for investment is much bigger than the impact of a 1 in 20 in longevity, right? Particularly if you're in, say, equities, like shares, because they could go down 20%, and that's a huge thing. Whereas if someone lives a year longer, actually maybe 3% increase in your liability. So relatively, longevity is not really the main risk. It's investment. But I would say, once you've managed to hedge your investment risk, so by, for example, buying more bond-like assets, which move in line with liabilities, therefore immunizing your asset and your liability movement, then longevity relatively becomes a bigger issue. And so some of the things they're doing is using longevity swaps, where you go to an insurer. So a life insurance, for example, so they take on mortality risk, right? So if someone dies early, then they make a loss, say. And so they'll want to hedge that with longevity, so that if someone lives longer, then they lose out. So a lot of them are quite interested in taking on longevity risk to hedge against the mortality risk in their books. And so you see a lot of insurers actually writing a lot of these longevity swaps with schemes. So it protects the scheme, and it's a good hedge for the insurer. But they're quite expensive. So if you look at the margins on the swap, on the fixed payments, it's pretty expensive. But there's ways around reducing that cost. For example, you could go straight to a reinsurer rather than go through an insurer. You could set up a captive, so your own insurance company essentially, and then not have to go through the insurers and intermediaries. So there's various things you can do to hedge it. But I would say for now, for the majority of the schemes, it's investment risk, not so much longevity.
And the movement from DB to DC, are there a lot of pension funds that are moving towards DC?
Yes, and I'll come on to that. Yeah. And then there's other add-ons. So I've just put together a graph of the results of evaluation. So that shows your benefit cash flows over 70 years. So essentially, that's the projected amount of money you're paying to your pensioners in black, and your deferred or your non-pensioners in red. And that's undiscounted, by the way. And so what you're seeing is, because a lot of these schemes have closed to more benefits being accrued, so they've closed the future accrual, they're now coming into runoff, right? Because the risk is too much, the deficits are too big, it's too volatile, nobody wants it, the employees don't value it, so let's get out of this thing. So a lot of schemes are now in runoff. And so because there's not as much money coming in, you're starting to see them become cash flow negative. So the assets, the money coming in is less than the money going out. And so it becomes more important to match your liabilities much closer. So a lot of schemes are reducing their risk, moving out of assets, moving into safer assets like bonds, which match your liabilities better. But then at the same time, they still need a good return, because if they want to eventually extinguish all the liabilities by moving into an insurer, the insurer is going to want a profit margin, the insurer is going to want a margin for prudence and all that stuff. So it's a bit more expensive to extinguish all the liabilities, and many of the schemes do want to do that. And so if you move into safer assets, then your expected return actually comes down. So looking at ways of balancing that risk-return trade-off, such that they can keep the risk low, but also have enough return that they have enough money to eventually pay the premium to extinguish all the risk with an insurer. Move on to the next slide. It then shows you, well, okay, what are the insurers holding? What sort of assets are they holding? As schemes are in runoff, what assets are they holding? And so I've listed, I think, about a dozen life insurance companies. And if you see the light blue line, that's credit, so your corporate bonds, for example. A lot of them are holding that credit. So it's not as, it doesn't give you as much return as, say, shares, but it gives you a little bit more than government bonds, right? Because you've got the liquidity risk and all that on top of the default risk on top of the yield for a government bond. So a lot of them are holding that, about 80% on average. And then the rest is largely in cash and in government bonds. And so that is what we see as more of a low risk investment strategy, where you have about 80% in credit and the other 20% in cash or gilts. Did you get it?
So when I just look at Aviva, PIC, and I think that's Rothschild,
Yes.
they've got very large proportion in other.
Yes.
Do you have an idea what that is?
That's a good question. and no. So I'll pick Rothschild Life.
Yeah.
So Rothschild Life is a subsidiary of Goldman Sachs. Goldman Sachs is the investment bank, the global investment bank. And now what Goldman Sachs did is they set up Rothschild Life so that they could then take on these liabilities that the private sector companies are finding too difficult to fund. Right? So they'll say, okay, pay a premium and we'll take on all the liabilities. So what you're seeing is consolidation of DB schemes within the insurance industry, right? Where they're taking on these and then they're having them under their arms. And what they really want are the assets. That's what they want. They'll hedge your longevity risk, so they'll take all of that out. What they really want is the assets, so the investment bankers can do their funny derivative swap things to make money. So I think it's that. They're doing some exotic stuff, private equity probably, and that infrastructure perhaps, and that sort of stuff. But no, I don't have the full breakdown of exactly what it is they're doing. Yeah. Okay. So I mean, what are insurers holding here? What assets? Property, I'm sure. What else? Property, yeah. More property. Right, okay. So I've talked about DB and how it's running off and how life insurers are taking on those liabilities and consolidating them. So if you then go back to the employees, well, what do they have now? Well, actually, whichever way you look, it's now a defined contribution. The risk is shifting from the companies who have to take on all that risk to the employees, who has to manage their own investments and then eventually manage their own income in retirement once they get there. And we've seen some interesting changes in, I'd say, the last 15 years in the defined contribution space. So we had automatic enrollment. So this is where the government said, right, we need everybody to have some sort of pension. Okay? In the private sector pension. I suppose the reason is if they don't have a pension, then they'll have to fall back to the state once they're destitute in retirement. So they said, okay, right, we're going to say if you have over a minimum number of employees, you're required to enroll them into a pension fund. Okay, right, over a number of years. They start with the bigger ones, and then now it's moving on to the smaller businesses. So even your small businesses are required to enroll into a DC pension fund. Okay? So what that means is your DC assets are going to increase because you automatically roll the scheme. But the thing is, employees are allowed to opt out. So say I join a company, I'm on this, I'm put into the scheme, I'm eligible to opt out and say, well, actually, I don't want to join the scheme. But only the employee can opt out. You can't opt out for your employee as an employer. So at the moment, we actually see not many. So we thought that as people are opted in and then they have to pay contribution and they see a lower take-home pay, they're like, what's going on here? But actually, we're seeing very low opt-out rates. So people are largely staying in these schemes, which is a good thing. That people are thinking about retirement and they're building their fund. But the thing is, how they've structured it, they said you phase in your contributions. So you might start with 1% in the first year as an employee, maybe 2% in the next year, and then 3% in the year after. So we're still at the 1% stage. So who knows? Once you see maybe 3 times as much money coming out, maybe you then say, well, actually, I'm not in anymore. But so far, it's been a good. It's been good.
You mentioned earlier that there's a trend where government companies are falling, and I suppose everything else is falling. What's your projection of how it's going to pan out for a DC fund in light of the future where investment rates are going to be? I think that's probably not going to work out for the member.
But I think you also have to look at it from a long-term perspective. In that, you're putting in this money, and it's not really that well. In many cases, it's not like you're going to want it next year. You know, you're probably going to want it in 20, 30 years' time. So I think you should probably have that in your mind in terms of, you know, just the longer term view. I think with the yields, we've probably reached the bottom. And I think, you know, the only way is up, because I mean, interest rates in the UK right now are what, 50 basis points? It's not 25, but you know, they're sub 1% interest rates. So I see, you know, it's going to go up. But I think it's better to have some sort of risk than to hold your money in cash. You know, if you're 20 years out, you really don't want to be holding your money in cash. You know, inflation will take over that. So I think with the longer horizon, I think you can be a bit more risky and a bit more adventurous. What I would say is though that the issue is not so much what the investments are that you go into. I think the issue becomes underestimating how long you live, and also not paying in enough. Because even once you pay 3%, say, under automatic enrollment, you know, let's face it, that is not enough money for you to live comfortably in retirement. And you know, these guys are going to live very long lives. The life expectancy is pretty high. And 3% contributions starting at age 50 is just not going to cut it. So you've got these two issues around people not paying enough and people living longer, which I think is a recipe for disaster. So I know we've moved from DB to DC, but I think we've moved too far this way. I think we probably do need to come back somewhere in the middle, where we do share some risk rather than shift it all to the member, because otherwise we're going to have a problem further down the line. Mark, difficult question.
This is an opening easy question. There were those proposals called defined ambition.
Yes.
And have they actually been reflected in practice?
No. Industry hasn't taken off. So defined ambition, which Mark is talking about, this was something that was mooted probably starting about 5 years ago, where it was a middle ground between DB and DC. So a company could say, okay, we're going to give you this minimum level of benefit, not as high as DB would have been. And then if our investments do well, then we'll give you a bit extra. So all you're saying is, okay, this is the minimum we'll give you, and then we've got ambition to give you more. But if we can't afford it because the equity markets aren't that great, then you know we haven't made you any promise, so we'll give you the base amount. So it's somewhere in between that. But I think industry had been, I think it came a bit too late. I think by that time, a lot of schemes had already moved from DB to DC. They were paying their 10% and say, hey, we'll leave the member to sort of the investment, whatever, we've paid our 10%, that's it. So to now then come in and say, look, how about you know, industry, we're just thinking, no, we're out. But I think some of these issues might mean it then comes back, that we might come back full circle in time, hopefully during my career. But we'll see.
Well, I hate DCs with a passion.
Mm-hmm. Exactly, me too.
Yeah, I think they're the biggest people that they've ever played. But in terms of, I just want to find out from a practical perspective, if you're able to in terms of just how much choice do people in the UK have on various things, money, how much to contribute, and so on and so forth. Because for me, that's one of the things that, you know, like you were saying, when an employer gives you a benefit, they want to see the fruits of it. So if it's a DB issue and someone doesn't see it,
Yes.
but it's one of those things that if an employer is paternalistic, you know what's good for them, and you're actually doing it for them. Because if you give me a choice of between 10 and 5%, chances are I'm going to contribute at 5% in the DC. That's exactly what's going to happen. But I'll appreciate it being forced at 10% 20 years down the line.
Yes.
So, but basically my question is just how much choice is there in practice in the UK?
So in terms of contributions, Tona, what you see is the way a lot of companies, the way they structure it is they match. So they'll match your contributions. So they'll say, okay, you pay, you're the employee, you pay 5%. And if you pay 5%, I'll pay you 5%, right? So you pay 5, your employer pays 5. So it's doubled your money, basically. And there's also the tax, there's a talk before tax, there's a tax gain. If you pay 6%, I'll also pay 6%. if you pay 10%, I'll also pay 10%, right? So the more you pay, the more you get. So that's a way to try to incentivize people to pay more. So that's one way they do it. In terms of choice for investments, there is a lot of choice. But the thing is, employees don't really make the choice. So in a DC, what you're required to do is you're required to have a default investment strategy, where if someone doesn't make a choice, they fall into this investment strategy that's been put together somewhere. And usually that'll mean, equities and some bonds, and then it'll be 15 years from retirement, you start to reduce the equity into bonds and cash to match annuity, and then you go into lower risk assets. So that's what most people then end up defaulting into, because the average man on the street doesn't know an equity from a bond. So they'll just say, well, I'm in a pension scheme, that's it. And they'll just fall into this default. But the trouble with default is each individual has a different attitude to risk. Each individual has different assets. Each individual has different, so you end up having a default strategy that doesn't suit anyone. So when you're trying to have one that suits everyone, it actually doesn't end up suiting anyone at all. And so this is one of the problems. And so the way we're trying to address that is, and I'll come on to some of the things I'm working on now in a personal capacity, is trying to engage these lay people more, right? So where you have an app, for example, which models, based on a 5% contribution and based on the amount of other assets you have, and based on what you want to have in retirement, when are you likely to get to that age? So it may start off saying your age is 76, and then you say, okay, fine, let me kick it up to 6%, and then maybe let me put more money into this risky asset. And then you see the modeling then shows, well, actually your retirement age is now 74. And you see, oh wow, actually, okay, so if I increase my contributions and I put a bit more money, then actually that means I can retire sooner. So it becomes a more tangible thing, rather than just saying here's 5%, here's 60, here's investment choices, and then call us when you're 65 and you want your numbers, and it's too late. So this is some of the things we're trying to do, and I know here in Zim I see EcoCash everywhere. You're starting to do financial services on your phone, which I think is a similar concept that they're trying to do with pensions. That it engages people a lot more. They can see, how they're doing, and hopefully that encourages them to make the right decision for them.
The matching, sorry.
Yeah.
Is that part of the flexible benefit scheme? So are they foregoing something for the increased match? Or it's just extra money? So
it's extra.
It's just extra.
Yeah, so it's extra. Yeah, because you sometimes have the pension scheme outside of your flexible benefits. So like you're part of the flexible benefits, and then your pension scheme is then because what they want you to do is pay more essentially and give you more. So it's not really a trade-off in that way. The only trade-off is to your take-home pay.
Same time you get more.
Yeah.
Is there flexibility to reduce? I mean, like, if once you have, like, I mentioned your contribution and you've gone to 10%, and then you begin to feel it's so on an annual basis change.
Yes, you can change it on an annual basis. Yeah, you can change it on an annual basis. Not many people do, if I'm honest with you. Pensions has got a stigma around it, as you're old, you're dying, so there's a bit of work there. But yes, you can change it. The only requirement though is because of automatic enrollment, that essentially means you've got a minimum that you have to pay. So as I mentioned as an example, 1%, then 2%, then 3%. So you can reduce it, but not any more than that, at least from a total contribution perspective. So yes, you can change it and move it up and down. So some of these tools that we're developing now allow you to do that on your phone, without having to phone some sort of helpline and go through a million questions. You can do it on your phone. Now some people say, well, actually, do you want someone to be able to sit at a bar and say, hey guys, look at my pension, look, if I do this, then, and then they actually make an investment decision there and then. So maybe it's a bit too easy if you make them be able to do it on their phone, but there's potentially a halfway house you can get to. Sorry, back to the other slide. 2014 UK budget. So this has been one of the, I'll probably say the biggest shake-up to pensions in the UK for a century. So essentially what it used to be is when you get to retirement, you have to buy an annuity. Okay? So annuity essentially, you get this amount of money until you die. So essentially a hedge against longevity, right? So you always get a pension and that's how much you get. And then they actually said, okay, rather than do that, let's let people, when they get to retirement, let's let them take their whole pot as cash, but we'll tax it, right? And I think that was a really, really neat trick by George Osborne, and I'll tell you why. Very rarely in politics will you find a policy that is popular with people, so getting cash was popular, but also increases your tax revenue. Yeah? So the budget announcement was a masterstroke, I think. So anyway, people can now take their money out when they get to retirement, which is another worrying thing, that people just don't appreciate how long they'll live. And the fear is that they'll take all their money and spend it and then not have anything else to use it on. But at the same time, you're trying to be liberal and you're trying to say, look, we trust you, it's your money, you've worked for it, you've put it into your pension, you've managed it, so you should be able to do what you want to do with your money, rather than us forcing you to do this. So it's been a big shake-up. So if you look at Australia did this years ago, probably 20 or even more years ago. And I think Australia is a very good model. Australia, everything that happens in the UK has happened in Australia about 20 years before, right? So it's always a good indicator of where things are going. If you look at Australians, in Australia, only about 8% of people now annuitize. So they've had this freedom for a while. Only 8% of people annuitize. 92% take the money without annuitizing. And if you actually look at what they're doing, what they do, right, is before they get to retirement, they'll buy houses, they'll buy holiday homes, they'll go on holiday. So they'll rack up debt, right, such that by the time they get to retirement, they then take the pension pot to pay off the debt and then live on the rent on the house that they bought, right? So it's kind of that sort of thing happening, which potentially could happen in the UK, but we'll see. At the moment, the pension pots are quite small, so it's very difficult. I know they were talking about Lamborghinis and people going to buy Lamborghinis and that sort of thing. But if you look at the average pension pot, I think all you can afford is probably a windscreen of a Lamborghini. So there's no way people are going to buy Lamborghinis because they can't afford to buy Lamborghinis. But that's an interesting one.
So like that kind of form suggests that there's something that's really wrong with annuities. What was Triple's problem with annuities?
So you had a few things happening. So you had the low yield, which meant that insurers, if you wanted to buy an annuity from them, they priced it very, very high. You also had a problem in the insurance industry where if someone had a policy with an insurer, a DC policy, and they're paying contributions, when they get to retirement, the life insurer would say, oh yes, you've got your retirement, here you can buy our annuity. And so what that meant is people didn't really shop around. There's no obligation for you when you get to retirement to buy an annuity with the insurance company you've been paying with for the last 40 years, right? But people weren't doing that, or at least they didn't know that they could do that. So they just ended up going into the same provider, which wasn't necessarily the best deal for them. And so, there's a bit of a lack of awareness. Probably the insurance industry could have done a bit more to raise awareness and say, look, you can shop around and that sort of thing. But that didn't quite happen. And then, as I say, it's a revenue earner, it's tax revenue earner. Rather than waiting 25 years to get your tax, if you let people take it all now, you can get the tax there and then. It's the liberal way of doing things, and as I say, it's been popular with the electorate. Maybe that means people will now contribute more because they say, well, actually, if I get there, then I get my money back. Rather than
insurers sort of coming back with better deals for customers who want to sell annuities. Started.
Insurers, they've taken a beating from this law. I think they're saying the first 3 months after the law was put in, they lost about 50% of their business. Because people just didn't come and say, here's my money, I want an annuity. And so where they see opportunity now is in the DB annuities, so the bulk annuities, rather than the individual annuities, which I guess helps the DB schemes because they've now got insurers who are not getting money from individuals and are now banking on this money from the DB scheme so they can negotiate a better deal, really. But the insurers take a battery from this. But I think the challenge now is to develop products that work. We know that taking all your cash is not a good idea. It may be that you have a product which gives you a minimum to pay your eating and your food and your bus pass, and then a little bit on top, you can then spend as you wish, go on holiday or whatever, but you've always got that minimum to fall back on, maybe. Or it may be that you get to age 80 and then it starts to you then have a payment starting in, say, age 85, and then you start at age 85 when you're older and you need more care and that sort of thing. So there's different ways that actuaries can play in this new environment by just being a bit innovative and a bit creative.
Yeah, I was going to ask, this law applied to annuities that were being paid at the time. They cash out as well.
So this only applied to new annuities. And so now the guys who retired in 2013 are saying, well, hang on, if I had waited a year, then I could have taken this money altogether, right? And so what that's then meant is you then potentially have a market for what we call second-hand annuities, where an insurer can actually go to someone who's already in payment and say, we'll buy that annuity from you. Yes, or actually we'll give you the money, and then we'll take the annuity from your previous insurer. Got it? Yeah. So you're essentially second hand annuity. But then how do you know that the guy's died as the insurer, right? You're making these payments. You don't really have contact. So there's a few things that they need to iron out. But that's probably one of the next big things is what you do with the second hand annuity. Okay. Any other questions or comments?
Yeah, Usborne was talking about someone getting an investment advisor when they get the pot.
Mm-hmm.
How effective is that approach?
When they get the pot, it's too late, Mabasa. You should be thinking about your retirement 15, 20 years out, rather than then be advised at that point that, okay, so I think, I think it's good. I think it's good that you have some advice. It's better than having no advice. And it's free, by the way. And it's free to the member, but it's actually paid for by the insurers. Right. So they've lost their business, now they have to pay this levy for the financial advice.
Come back.
Exactly. So it's a good thing, but I think that discussion about your retirement and how you spend your money has got to start much earlier on. We have to be raising awareness, because by the time you get there, you realize you don't have enough. You can't do anything about it. Whereas if it was 15 years ago, at least you can say, okay, look, you're not going to retire, you're not going to be able to afford to retire at 65. Right now you're looking at retiring at 75. And then you say, okay, fine, let me double my contributions to bring forward my retirement date. It's just far too late to be having that conversation then. So a bit of awareness and education and the whole engagement thing that I've mentioned before, that's required. I mean, how does that compare to Zim? Is it also very much moving towards defined contribution, or it's there already?
It's there already.
It's been there.
That's why.
Yeah. Or is it because you don't get money, there's no actuarial as much
Not
actuarial?
really. I think it's that whole move when you're transferring the risk from the company to the individual, you're paying the contribution rate. So essentially what you're doing is you at this contribution rate, you're going to run a deficit. So if you're no longer going to run a deficit because of federal DC, it means I'm going to get a rubbish benefit. The money isn't going to come from anywhere else.
Yeah, so it's a low, yeah, you're losing it, yeah, that's
So
it.
essentially that's what it is.
Yeah, that's it.
Yeah. But well, if it keeps the employer going, at least I'll get to it.
Yeah.
So it's something else.
Yeah. So there you've got very much an aging population, and longevity risk, at least from a DC perspective, once you've retired, is a big deal. I'm not sure to what extent you guys have issues with people living long or whatever, but maybe you will. I saw a lot of people jogging around. There's a lot of people jogging this morning. So, you run over them. Yeah, exactly. Yeah, that's true. They're running on the actual road, but yeah, okay. So that might counteract the thing. So that was the UK budget, which brings actually a lot of opportunities for actuaries. I don't know if it's the next slide, Sam, that then talks about that.
Sorry.
Oh, sorry.
On top of those that are going to live longer,
Yes.
how feasible is it to introduce reverse mortgages in Zimbabwe?
Oh, in Zim.
Okay, maybe.
Well, there's a bit of a cultural difference, though, isn't there? And then in Zim, I've seen a lot of houses being put up, right? Which is something that surprised me, because in the UK, if you read BBC, it tells you the economy is crumbling, the economy is on its knees. But I see houses that are bigger than middle income people's houses, and so, you know, they're proper structures, you know. So there's house going. But I feel people see homes as almost a heritage. You know, they want to build their house, they want to leave it to their children. You know, so culture, I'm not sure whether, you know, you can say, okay, fine, I've worked hard to build this house, and this is what I'm going to leave for my children. But actually, let me do a reverse mortgage, and you know, and protect. So I'm not sure whether culturally that will work. I don't know. What do you guys think?
I think that would be
Mm.
cultural.
Yeah.
And the lack of trust for financial institutions.
Yeah. Yeah. And maybe the community, how do you explain it to the normal guy as well? You know, can you explain that to someone who isn't, you know, like us in the financial industry?
But one of the biggest challenges that we actually face is the level of interest rates in this country. So the amount that you're going to give someone is what you probably need to avoid reputational damage and everything else, because you're going to give someone 20,000 for your house or 200,000. When their family wants to take it, when you come and take it over, then they're saying we paid 20,000.
Yeah.
It's
Yeah.
going to just end up
Maybe the way to go is to target multiple owners rather than targeting people with just one owner.
Yeah, maybe almost, yeah.
But then maybe your rental is sufficient.
What, you won't have enough rental yield?
I'm saying like they have so many properties, so they may have insufficient rentals and not be interested in setting off share properties.
How are we doing for time? Okay. So we're in DC, right? DB is gone. It's all with the insurers now. Everybody's in DC. Tawana doesn't like it, but everyone's in DC anyway. And so what are the models that we see in the UK? I'm not sure if it's the same here in Zim. So on the left we've got single employer trust, which is a bit akin to the DB setup, in that you've got a group of the scheme is set up under trust. You've got a group of trustees who look after members' benefits and interests in that scheme. So you've got a single employer trust. On the other end, you've then got a contract plan, where actually you outsource the management, and actually you probably don't have much to do with it. So it's a contract between the employee and the insurer. And you as an employer just don't actually have a stake in that. All you need to is pay contributions to that insurer on behalf of the member. And then in between, you've got what are master trusts. So I think they call them umbrella funds in South Africa. So you've got the insured master trust. This is where an insurance company then consolidates all the different schemes under itself. And so what we see in the UK is a move towards these multi-employer master trusts, where you've got a number of different employers. They've got their schemes, their DC schemes, and they don't want the governance, they don't have the meetings, they don't want to spend money and time on this pension scheme. That's why they moved from DB. And so they want to give it to someone and just say, okay, here you go, you're a professional, you run it. And so one of the things I'm working on is Towers Watson has set up their own subsidiary, which, you know, I mentioned the consulting model and the move from that. The way they see it is, given the defined contribution assets are going to go up, you know, you've got automatic enrollment, you've got the budget, so people are going to pay more. The consulting model doesn't quite work in DC, or at least it doesn't work as well as it could, right? Because if you're consulting and it's a £5 million fund versus if it's a £50 million fund, your consulting fees actually aren't going to be increased in proportion. They're not going to be, you know, proportionally different. You know, they can be pretty much the same. Maybe higher for the bigger scheme, but actually essentially not 10 times as big in that example. And so what you want to do is, to get the most value from this increase, what you want is for your fee structure to be proportional to this increase, this huge increase that we're going to see in the next few years. So what they've done is said, okay, let's set up our own master trust, right? And we'll get in all these employees to come into it, right? And then we'll charge a percentage fee, an annual management charge, to the members. And so as the funds grow, you know, your annual management charge, even if it stays the same level, it becomes a bigger nominal amount. So So that's where they see the growth in revenue now coming in. It's kind of shifting from your consulting, spend 5 hours at £200, get 1,000 to more, okay, depending on the size of your scheme, we'll take our 0.5% of that as a management charge. Which I think is a very interesting thing. And the way it works is because we already consult and we already have administrators, we give administrators, we've got DC consultants, we've got investment consultants, we do communications consultants for members. Well, actually, we can do all of it in-house. So these schemes come in and we can actually service them all in-house using the existing capabilities that we have and the talent. The only thing we can't do is we can't manage the funds because we're not an investment manager, we're consultants. And so what we did is we got legal in general to then come in, and so they also have their management charge. So they manage the funds, they get a bit of a share, and then we keep a share. And so you've actually then formed what I think a quite a powerful strategy to really take advantage of the growth that will come in defined contribution. And so my role is setting up the operations for this new vehicle. So looking at all the governance, the structures in place, because obviously employers have to be comfortable that what they're putting their members into is something that works and is engaging and is going to mean that they contribute more and they're more active and interested in the pension scheme. And so it's a really interesting product, and I think it shows where things are moving to now. So there's a modeling platform on that, which you can see where your expected retirement age is. So it's a very interesting product. It's an interesting thing to work on.
Maybe you can just elaborate a bit more on what exactly the customer is paying for. Like for the member, what additional benefit would I get under this new arrangement?
Elsewhere.
Under the old arrangement where you were charging £500 now.
So as a client, you as the employer, you had the scheme, you had to attend the meetings, you had to do the administration, and you had to spend a lot of time on it, basically making sure everything's going well, contributions paid on time, in full, any investment changes are made. So it took a lot of time and effort for you, and that comes at a cost. But under this new model, what you're doing is essentially outsourcing that. So you're saying, I'm going to take this fund out of my hands, I'm going to give it to you as an insurer, you as a master trust, and you deal with that. Just let me know if there's anything I need to do. But otherwise, my job is done. So in terms of governance, it really lowers your cost and your time. And the other thing is, the member then pays for the thing.
So what does the member get? Because now all you've done again is lower the cost for the employer.
Yes.
You're charging the member. And what is the member getting?
What the member gets is, what you're doing is you're engaging them in their fund, in their product. It's all online, right? So we're not sending you reams and reams of paper, which used to be the case. It's all online. You've got an app, you've got a platform where you can see your funds, how they're moving every day. You can make your investment changes. You can increase your contributions. You've got this modeling platform. And so what we're saying is, by doing that, we're going to see members having more adequate benefits when they retire. And so that's what they're paying for. They're paying for this whole snazzy platform. They're paying for this digital communication, which is timed such that it's at the right time for whatever changes you're making. And they're paying for the fact that they know what's going on and they can easily do what they need to do, and they don't need to wait another 10 years once they realize once they get 65 they have to wait another 10 years before they can retire. So that's essentially the product. It's selling an engagement tool, really, and that's what they're paying for.
It's quite interesting.
It's very interesting.
Yeah,
it's very interesting. It's very interesting.
Yeah. That's it.
It works for everyone, doesn't
Yeah,
it?
it does.
As a company, it's very difficult for us to. Well, it hasn't been very often that we work all together. Whereas now you've got the investment guys, the administration guys, the communication guys, the consultant guys, all working together for this product. So it's working right across the organization. So if you look at the organization, you look at the employer, you look at the member themselves, it works.
interesting, the product. But I wanted to ask how you're managing the expectations. If there's some projections that it does, and those projections maybe sometimes changes once in a while. So how do you manage the change, the smoothing and so on?
Yeah, so there's the assumptions which we're taking a lot of time to think about. What's your investment return over the period in which you retire? But I think what you have to remember is, with a lot of the work we do, we're not as actuaries, we're not predicting the future, right? We're not telling you that this is what's going to happen. What we're doing is we're showing you the scenarios, we're highlighting the risk, and we're sort of helping you to understand that and help you to make a decision, right? I talked about caveats and all that. But with this product, it's not so much what the actual age is; it's more the relativity of it. That if I increase my contributions by 1%, how many years does that mean it comes off? So it's not that am I going to retire at 74? It's that if I increase my contributions, I can retire earlier. That's essentially what you're trying to communicate to the person through this tool and through this platform. Yeah. So it's almost an education engagement, tool, but not in your conventional sense. Yeah. So the modeling is exciting. It's interesting. We can get all actuarial and term structure of interest rates, all of that stuff. But really, it's what we're trying to do is we're trying to say if you pay more and if you invest appropriately for the age and your aspirations, then you can, because that's a lot more tangible, right? People don't understand what investment return yield and when do I retire? How much am I going to retire on? That's what I want to know as a man on the street, and so that's what we're trying to do.
Since you're talking so much about people, wanting to know about retiring earlier, because indeed there's this issue of longevity, which means that we have more post-retirement years. Maybe problems if we are unproductive unless if they are building something.
Yeah.
So, and also I know the government has got plans to shift the retirement date forward over a time period. How does
that work? Well, actually, the state retirement age is different in that that's for your state benefits.
That's true.
So that's different from private sector. So actually, you can draw your benefits anytime from age 55, irrespective of what the state pension age is. It's just that your state benefits kick in at a certain point in time. Now, I'm not saying it's not important. It is important because it may be that you can spend some until it kicks off, and then you can then reduce the amount you spend because then it's then taken up by your state pension. So it's not entirely, but it is quite independent. So it's not that when your state pension comes in is when you should retire. You can retire before or after that. But in terms of longevity, that is what we will allow for when we're doing this modeling and showing when is the age you retire. We'll have some life expectancy numbers in there. So what we essentially say is, well, how much do you want to retire on? What's your aspiration to retire on? And based on your contributions and your investments, when would you be able to retire on that amount that you want to, at what age? And then how does that shift if you do different things now? Yeah. Does that answer?
Yeah, it does answer. I mean, of course, there was a sense that there could still be need to give them that clear advice, but because of the longevity increase, we have more years when the person has to make a sound decision as to whether they truly want to live this productive working lifetime and going into, because it's exciting the thought of going on retirement and being free from work, but if it becomes for a longer time, maybe someone needs to think maybe I should have, of course they can always come back to work, but
So the actual tool, I should have brought some screenshots of the actual tool. What it actually does is it shows you, so stochastic modeling, it shows you your percentiles, your chance of it. So it actually has, when it shows your age, it's got the median, so the 50th percentile in the center. And then it's got I think it's your 60th and your 40th just to the left of that. So it might be 75 and then 78 and 60, 69, for example. And so it's showing you, so those stochastic results, but not in the funnel that we're used to. So it does allow for that, and it allows for the fact that this is all uncertain. There's uncertainties in here, but without actually using those words, because once you start talking about that, then so it does try to demonstrate the the range of possibilities, right? You know, that it could be different, but at the same time try to give you some sort of indication of, okay, it's 75 rather than 55. You know, so you want to have 100K a year at 55? No, it's not going to happen. You know, that's what I was trying to do. A question?
Yeah.
Ladies first.
Yeah, ladies first. Yeah.
Alright, I wanted to ask, you highlighted that the major risk in the UK market at the moment is purely investment, and under DC, the role of the actuary is more like to highlight the investment risk. And I'm thinking, can the asset manager do that? And if that's the case, are actuaries actually obliged to be in the model? Can't we have, okay, is there any regulatory protection for the member to have an actuarial involvement? And if the actuaries are going to be involved, would there be a change of roles from maybe what actuaries would do under the DB structure and in this model?
Yeah, okay, I think you probably had about 3 questions in there. I'll try and pick each one separately. So in terms of the actuarial involvement, so yes, it's not like DB where an actuary had to do the valuation. So you've got much, at least on the surface, you've got much less need for actuary, at least no regulatory requirement for an actuary to have to sign off anything in the DC space. But I think actuaries do still have a role. You mentioned investment managers. But the fact is, investment managers, they know the assets, they know how to get return. But what we're talking about here is not really just getting the highest return. It's more looking at what it is that you're targeting and trying to get the return, that trying to structure your assets that give you the best chance of getting that return. So I don't know if you catch what I mean. So it's not necessarily that you have to get the highest return you can. I think it depends on what your objectives are. Almost similar to the DB. Where you've got your liabilities and you want to have the assets that best match or best move in line with those liabilities, which is not necessarily the same as having the assets that have the highest return, because they might have the highest risk potentially. So I think investment managers, yes, they know all about the assets, but unlike us, they don't know about the liabilities. So I think there is still a role there for actuaries. One of the things is, if you're putting money into a DC fund as a member, and you see the total fund being less than the contributions you put in, you're going to start thinking, hang on, is someone stealing my money? But it might just be the market. So, you could have things which are like capital guarantee products, say, where the actual money comes in is kind of the minimum. So there's different things that the actuaries can help with, which the investment managers might not necessarily be able to. So I believe there is a role for actuaries even in DC. And some of this stuff I'm talking about now is there's probably half of the team is actuaries. So yeah, there definitely is a role. Did I answer all your questions?
Yeah.
Did I?
Mm-hmm. There is another one on regulation. GSC, would you lobby for the regulation part to change in the UK setting, or you'd be more comfortable with the issue of with the scenario where the actuary engages more with the members?
I think actuaries can play their part, but I don't think that part is best played by interacting with members directly. I don't think. So I think it's stuff like this where you're showing them the modeling and they can use that as a platform to have a conversation with their independent financial advisor. In terms of one-on-one, I think we're far too expensive. Someone would have to pay for it. So us talking to members one-on-one might not quite work that in my perspective. But there's other things we can do in the background which can help that conversation, highlight those risks, allow members to be able to make the best decisions for them.
I wanted to ask, are there specific reasons why probably insurers are not offering the multi-employer master trust type fund, or do you think we could see in the future a movement towards that type of offering from the traditional insurers?
Yeah, so the insurers are playing in this space. One of the things is, as it says there, that the insurers will do everything. You don't have that personal touch. So they'll consolidate all the schemes, and every single scheme, every single member will get the exact same service. Right? Now, there's some employers who, although they've outsourced, they still want to know our members complaining, and if they're complaining, what are they complaining about? They want a regular update. They want to know how many of my members aren't paying into the scheme, for example. They want a regular update, how much contributions, what changes have they made. And so it's a bit rigid in that sense. Whereas the multi-employer master trust can be a little bit more flexible. It can be done on a bit more of a bespoke basis. Now you probably have to pay for that, in terms of consulting fees on top. But there is the possibility for that. But I think in terms of the multi-employer master trust, I do see that going up. But the one thing I would say though is there's a first mover advantage, right? Because once as an employer you go to a master trust, you're very likely to change in maybe say 10, 20 years. So you've gone there, you're going to stay there. You're not going to be doing annual tenders. It's just too costly, it takes too much time, it's disruptive. And so the guys who go in early and get as many will be set for at least the next couple of decades. So I do see it going up, but I think there is a small window of opportunity before it becomes more difficult.
So meaning at the moment it's not as prevalent as the insured.
It's pretty nascent, yeah, it's quite nascent at the minute. It's pretty nascent at the minute, which is why we're excited, right? We're pioneering. But it's a challenge. You're trying to set up, it's hard enough trying to set up a project or an operation in a market where you can see what the competition is doing. You can see what distribution are they using, how they're pricing, how they're marketing. But in a situation where there's very few other players, it's very difficult to know whether your product is, there's probably only two serious players, whether your product, how it compares to the other guys, because the other guys actually haven't quite offered it yet. They're in the same place as you. So it's hard to see how you're doing against the competition. Is your pricing right? Is it too much, too little? So it's challenging, but also interesting, and you've got a much wider scope to play around with things, which is interesting. How are we doing for time, sir? Okay, fine. Shall I wrap up? Okay, so the future for actuaries, I just thought I should show you some stats on the next slide. So some of the things we look at on council is, we kind of horizon scan, right? So where's the profession going? And so what can we do now to help in that progression? And I think to understand where the profession is growing, it's good to look at students. Right, so you look at the student population, that's a good indicator of so looking at the student population is a good indicator of where things are going in future. So I just put together some stats. I know you guys like numbers, so I thought I'd put some numbers. So this is all students of the IFOA, right? So it excludes qualified actuaries. Looking at the top left, 57% are outside the UK, and that's growing. Okay, so it's very much, it's a London-based, UK-based, but actually it's very much an international organization. And it's going to take a while for it to shift mindsets so that they completely grasp that point. Wherever you look, it's more members outside of the UK than inside. The mature markets are flat, so your UK, your Australia, student numbers are flat, they're not going up. Okay? Where we're seeing the growth is actually in China and Southeast Asia, which is up 10%, this is the year to October 2014. And Africa, excluding SA, up 8%. South Asia, which is India, up 8%. That's where the growth is coming from. Yes. Then if we look at the practice areas, so how the practice area is changing. So the grey box, pensions is declining about 2% every year. Life is declining about 1% every year. But the thing is, with life, I mentioned at the top how developed and developing are quite separate segments. Life in developing markets is actually up. So in Africa and Southeast Asia, life is going up. Globally, it's going down, but in the developing, it's going up. GI, so general insurance, is growing in all regions. So UK, Asia, Africa, everywhere. But mainly outside the UK, as I mentioned before. So wherever you look, GI is going up. In fact, GI has just overtaken pensions in terms of number of students. And at this rate, in the next between 5 and 9 years, it's going to overtake life. Okay? So GI is increasing. And if we look at other areas, investment management is going down, maybe CFA related, maybe people prefer to do CFA than actuarial if they know they want to go into investment management. Risk management and health, they're pretty small. So if you look at the bar chart, sorry, I don't have the actual stats, but if you look at the bar chart, it's very tiny, but it's growing very fast. Health and risk management. And Zim, interestingly, you know, when they show these stats, I always look for where's Zim. Yeah. Zim is top 10 by headcount, which if you do a pro rate on the population side, it's actually pretty disproportionate. So it's a very high number of students in Zim. So, you know, that's just a snapshot of what's happening within the profession, you know, see what you like. But I think, in my view, we just need to expand in terms of our practice areas as actuarial students and as actuaries. I think that's what we have to do. And I think to do that, there are a few things we need to fix. First, we need to know who we are. You ask any two actuaries, what's an actuary? They'll give you two different answers. So I think we need to understand exactly who we are and how we add value to the general public. And I also think we need to fix our education. I think our education is far too long. It takes far too long. It takes far too long. You then lose the bright and able people because, you know, who wants to be studying for 7 years? It shouldn't be less difficult. It should be as difficult as it is, but it shouldn't take so long. And the other thing is, I think it's too UK specific. You know, as I mentioned, we've got two completely different segments, and so I think we just need to test the skills and the competency, but not the actual regulatory context, for example. I think that needs to change. And so those are some of the things we're looking at. I don't know what you guys think about the future and what we need to do.
Perhaps, especially in the fellowship paper, maybe we'll see more options, picking questions.
Yeah.
It's not practical for you to be.
Yeah. Yeah. I'm going to quote you. Yeah, okay. Yeah, okay.
Another easy question.
Yes.
What about competition from other specialists in sort of mathematical fields?
Mm-hmm.
Is it a serious issue as far as actuaries are concerned?
Yes. 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 It's a big issue. It's a big issue. You know, the benefit of being in a profession is that you've got the actuary's code, you've got the ethics, you've got the standards, you know, and so, you know, you're doing the right thing, right? And there's a benefit to that. But there's also a cost to that. And that cost has to be borne by the client. And so you see guys who know the maths, right? They're not actuaries, they know the maths. They can communicate probably better than some actuaries. But they're not an actuary. And they're cheaper. Because they don't have to do the checklist of APS, whatever. They don't have to do the guidance notes. They're cheaper. And so clients will say, well, should I pay more for that guy or less for this guy? So I think there's a role for us in getting clients to understand that yes, we're a bit more expensive, but this is what you're getting for the extra cost. But yes, it definitely is competition. And so part of what I think we need to do when we look at education is think, okay, what sort of skills do we want actuaries to have? So if you look at data scientists, for example, they've got a lot of the skills that we want. So if we fix our education, is there a way that we can get data scientists to come in, maybe do 2 or 3 exams, and then become part of our family? You know, and then we'll end up having actuaries everywhere, and as we have more actuaries, then maybe people start to appreciate that, oh, so these guys also do data science, oh, they do risk management, finance, you know, and then we kind of, you know, go up that way. And then once one of you makes it into data science, then you'll know that, you know, I need a team of actuaries, and you're going to bring other guys in. So I think we do need to spread out, we do need to articulate our value to clients, and I think that's what will keep us going in the future.
Just a question on what's been the uptake on the let's call it certified actuarial analyst?
It's been tiny.
Yeah.
It's been really tiny. Everyone wants to be a fellow. Let's face it, I was in Ghana and I was teaching CTA, and I was saying to the guys, the CAA, why are you doing this? Do CAA. And they said, I'd rather have an old Mercedes Benz than a new Toyota Corolla. Something to that effect. Something to that effect. So everybody wants to be a fellow. Not everyone will make fellow, but everyone wants to try to be a fellow too. So there may be some way we can maybe bring the CAA as a foundation for the fellowship, perhaps. So if people get to CAA, or they can stop there if they want, or they can move on to fellow without having to do all this cross transfer and window to transfer and all of that stuff. So we can make it more streamlined. And then again, bring in people. They come in, they do CAA. They think, oh, okay, maybe they need to just do a few more exams and become an actuary. So there's different things we can do. The CAA hasn't quite worked. It's still early days though. So who's to say it won't kick up, but for now, not yet. Not yet.
This one, thing from me, I think from what you say, the reason why you won't find people actually saying the same thing is because I think the problem is actuaries tend to be too focused on what they do. I think actuarial skills can be used in far much wider fields with doing far much wider things, but if you ask pensions actuary, they'll tell you what a pensions actuary actually does, as opposed to life actuary and so on and so forth. But I think if we were to define the skill set that we actually give people, I think that will actually work. I think another important thing that we may need to think about is if we are going to be useful in the wider business environment, especially, we need to stop teaching negative risks only. We need to start teaching risks in a positive way. That helps, because the thing that you find that as an actuary, you're trying to get up the corporate ladder. Whenever you get a business idea, someone talks about a business idea, the first thing you think of is white unicorn, which is not the right way of doing business. So I think somehow we need to try and, so there are good skills in terms of you need to understand the risks, you need to mitigate the risks, but we also need to, find a way of teaching how to take advantage of risks.
That's true. Yeah, and we're having a conversation with Sam last night, covering similar things. Like, yes, it's right. To make profit, you need to take risk. It's basically it. You're not going to make profit without taking risk. And if I'm honest with you, the best actuaries I've come across are people who aren't actually actuaries. So I've only found out that he's an actuary. But he's actually, either an entrepreneur or a business advisor or and then he's also an actuary, and those are the best guys who I've seen, so it's not that, here I am, I'm an actor, I can do numbers, look at me. But it's actually, I can help you take those calculated risks, move into new areas, advise you, and I've got an actuarial background, those are the best guys I've seen really. So we probably do need to move away from what is it that we actually do, but to how do we actually help? How do we help you as an employer? How do we help you as a person?
Do you think there's a sense within council that the exams are too difficult?
No. Ask any actuary, and they'll tell you the exams have got easier since I qualified. That's what they'll all tell you. So yeah, quite the reverse. Quite the reverse thought. But I think we most of us are agreed that it takes far too long, and there's a restructuring that's probably required, which we're looking at now.
How long did it take you to be an actuary, and you had some exemptions from your college degree?
Yes, I had exemptions from my degree. I had 6 exemptions. The year after me had 7, the year after me had 8. So if I was born 2 years earlier, I would have had 8 exemptions and saved a year of my life from studying. That wasn't to be. Yes, I had 6 exemptions, and I started in April 2007. That was my first exam. I did CT4, CT8. Those are the 2 I didn't get exemptions from. I failed them both. So you do fail, but and I think the other thing is the actuarial exams, they're tough and they're long, but they actually teach you to be resilient, and they teach you to set your mind to something and go for it and get back up. So, you know, I'd say that was a positive from my exams. Even failing your first set of exams and you haven't failed in your life ever is tough. It's a bit of to swallow.
Do you think there's great scope for innovation in the profession, and maybe is there anything exciting happening? Well, as far as
yes, there's a few things. So what comes to mind is probably driverless cars. Is one thing. So in the UK you're getting driverless cars coming in, and so what does that mean for insurance? Who are you insuring? The owner of the car, the manufacturer of the car, the driver in the car. You know, So there's interesting things. There's also the usage-based insurance. So where you've got a black box in your car, and that pretty much prices you based on how you drive, or how much you drive. So if you brake a lot and you take a lot of hard turns and you accelerate very quickly, your premium is going to go up. But if you drive safely, you know you.
How does it actually know that you're the person driving?
But it's insuring the car, so if it's just that car.
No, but in the UK you
insure
insure by the driver.
Yeah.
Of course.
Yeah.
Okay.
Yeah. So there's all that stuff. Yeah.
Link it to your phone.
Yeah.
So very I remember when
So those are the innovations. Clearly there's lots to talk about in that area. And we've also got on the health and life, you've got wearables. Right? So you've got a life insurance policy, you've got a wearable, you jog every morning. It lowers your premiums because they say, well, actually you're actively fit, so you're less, so you've got all those sorts of
Just go like this.
But you still exercise. So you've got a lot of that sort of stuff. Maybe we're going to go to the last slide, then I'll wrap up for a couple of minutes. One after that. Yeah. So I think in terms of you, I think it's engaging with the profession. Hopefully this has allowed you to see that you should be. We want to hear from you. It's a very different market, and sometimes you don't see the context. So we do want to hear what you guys have to say. A lot of the stuff we're doing now, this mobile-based stuff, is stuff that's been here for a number of years. So I think there's also stuff they can learn from us in the same way we can learn from them. And I'd also say things like volunteering for the profession. That's all really valuable stuff, and it's not just for charity or it really does help you to build your network. It helps you to enhance your soft skills, which is all stuff that as I mentioned will matter. So it's not just the number crunching. It's can you talk to someone and convince me that the action that the numbers are suggesting is the one I should take. So it becomes all those softer skills, influencing, presenting. And that sort of thing. You can get a lot of that from volunteering, which you might not get in your day-to-day job. And you just have a wider network and a wider view of the world outside of your own day job. For example, at the Actuary magazine, we're looking for a new features editor, and we've had some interest from Zimbabwe. So one of the questions I'm asked is, can I volunteer from Zim? Like, of course you can volunteer from Zim. I've been here for a week and I've been able to do my work. You've got technology which allows you to call, see someone, send email, so there's no reason why, you can't join a practice board or a working party and contribute from here or from Timbuktu, wherever you are. So I would say, do try to get involved as much as you can. Do try to engage and build your contact base, and it will be worth it. I can tell you that. Yeah, and share your unique insights. There's stuff we can learn from you, just in the same way there's stuff you can learn from them. Okay, but yeah, thank you very much. And if you have any other questions, I'm happy to take them. But I'm also hanging around if you want to ask questions one-on-one.
Certainly would like to thank you, Kelvin, for the quite insightful presentation. I think we all learned a lot from what you presented. And I think I was touched by your last slide. I think we'll all be encouraged to volunteer for our own local actuarial society, since I know a lot of us have been very reluctant to volunteer. And we hope in the future you continue to come and do more presentations and most certainly link us with other people who can also present. Maybe in closing, I would like to say we have some refreshments outside, so feel free to have the refreshments. And